All right, we're live. Do I have? Oh, there we are. I was looking for the viewer count. Uh, what's uh, what's the weather like there, Farhan?
In Estonia,
Yeah,
it's probably in negative Celsius. Uh, Probably.
that's uh,
Let me check.
that's not even. We're at the time of year where
Uh,
negative Celsius doesn't even
what
shock.
about DC? What's
Right
in?
now, last time I checked, it was about -10 Celsius in DC. So we're dealing. It was also the coldest temperature in the entire uh, continental U.S. yesterday was where I was this weekend in West Virginia, where it was negative 28 Fahrenheit, which is like close to that, like like -30, yeah, -30 Celsius or so.
Oh wow,
It was very cold.
wow.
So excited to talk about solar and manifest the sun in my mind right now. Uh,
It's actually 2 Celsius in Estonia. It says.
okay, so you're above. Although it might have gotten warmer in the afternoon. Oh no, it's 21 Fahrenheit here, negative 10-ish.
Wow.
Cold. My daughter, of course, didn't wear a jacket to school today because she was trying to prove a point. So here we are. We'll see if she comes home or not.
I'm not that.
Uh,
Um,
I see the numbers ticking up. We'll give everybody another minute to trickle in, but appreciate you all joining. As is, I guess, the tradition at this point, feel free to chime in the comments. Let us know who you are, where you're from. We can predict a few names and places that we'll see popping up. We'll get started in 45 seconds or so. Is there a way? There's no way to. I can see the count. I don't get to see who's viewing, which is interesting. But I'm gonna click around on some banners, schedule a call. All right, 20 seconds, and we'll get started. Farhan, do you know? I don't know if you saw the sign up list. Do you know what percentage of the folks who are joining we've talked to before, and how many are new?
I haven't looked at the list. Honestly, I.
Also the list of who we've talked to already is quite large at this point, so can't always recognize names.
Hard to keep a track. Yeah, I mean.
All right, we can get started and let people show up as they do. We got a good big number already. So welcome everyone. Again, feel free to drop in the comments. Let us know you're here. I'd love to know who we're talking to. Always kind of a little bit easier than just talking to a blank space. I see Justin. How's it going? Solar. We're here to talk about solar today. It's that time of year. We did a bunch of work with probably many of you end of last year, and now we're getting rolling for 2025. We're going to talk today about the theory behind solar, how it works, and then at the end, we'll really talk tactically about how you all can get started and why you might want to get started earlier in the year as soon as possible. Let's just get into it. I think most of you know both of us at this point from either calls you've had with us or other webinars. I'm Jeff. I run product and partnerships here at Valur. I'm a lawyer by background, although that is a less relevant fact, I think, in the solar context than when we're talking about trusts or other things, but maybe helpful to mention. And Farhan, you want to introduce yourself?
Yeah, so Farhan Akhtar, I am on the ordinary income side of things at Valor. On the ordinary income, we have two major solutions that you already know about: solar and oil and gas. And whenever you schedule a call, so you're gonna go through me. So yeah, I've been with Valor for about 2 years now. It's been a great experience, and
They're
happy to get
they're
on.
going to go through you at least for the time being. I think I know your schedule is quite packed, and we're going to be adding a few other folks they'll get to talk to in the near term. But yes,
It's a
Farhan,
good problem to have.
yeah.
But
So what's the plan? Hey, Afzal from New Jersey. the plan today, we're going to start from the ground up. If you've spoken to us before, the beginning of this presentation is probably going to be a little bit remedial, which I hope is fine. I think we'll go through how this works, the math behind the benefits. We'll maybe speed through that a little bit because I know a lot of you have heard that before, and we've spoken about it on other presentations. Where the focus will be on this presentation, I think, will be breaking down the flip partnership structure, which is a little bit complicated and definitely helpful for you all to understand. Talking about timing, if you spoke to us last year, and especially if you tried to do solar with us last year, you'll know that timing is critical with this sort of thing, and we'll talk about why you might want to get started in the first quarter of 2025. We'll do a case study. We'll show you the Valur tools that you can use to model solar for yourself, get a sense of what size of project would make sense and how much your tax savings would be. We'll talk about the process, how you work with Valur, who our developers are, how you get started, and what that process looks like. And then, of course, we'll leave time for Q&A, but definitely feel free to chime in with questions as we go. I've got the chat open, and we'll answer those as best we can as we're running through. All right. What is solar? What are solar benefits, solar tax incentives, and why are we talking about them? Solar tax incentives, like really any federal and state tax incentive, are something that's been enshrined in law and that where the government has a particular purpose in incentivizing these projects. So solar credits and benefits have been around for a long time now, about 20 years. And so this is not a new program, but 2022, really 2017 and 2022 are when these benefits became large enough and applicable enough to enough people that it made sense to start thinking about them as a potential path for retail investors, for normal people, as opposed to corporations and other large entities. We'll skip over 2017, but as a result of that 2017 tax bill, depreciation got a lot bigger. The real big sea change was in 2022 when Congress passed the Inflation Reduction Act. As you know, I'm sure, the IRA has a bunch of language in it and a bunch of provisions having to do with clean energy. The ones that we care about here specifically have to do with what's called the investment tax credit, as well as bonus depreciation, and specifically applying to solar and other renewable energy infrastructure. The Inflation Reduction Act implemented an increase in the various benefits that apply to these projects that now make the math pencil out for people like you. And we'll talk plenty about what that looks like. So what is this, right? The basic idea here, as many of you know, is that you can get these incentives, these credits and depreciation, as well as project income in return for purchasing physical solar assets, that is actual solar projects. So this might be an array of solar panels on the roof of a university. It might be a packaged group of installations on residential buildings. It might be a ground-mounted array in a subdivision. Whatever it is, it's physical solar panels, and you are buying them outright and becoming the owner or a partner owner, as we'll see in a little bit. And in return, you get those three benefits: tax credits, depreciation, and project income. We'll take those one by one and really dig into what they are, how you get them, and what the math looks like. And then we'll talk about the mechanics a little bit. So Farhan, maybe do you want to talk about the mechanics a little bit, kind of beginning to end, how this works?
Yeah, thank you, Jeff. So one thing that I would like to clarify here is, when you're thinking about solar, and we're using the word here, purchase, is that because it's a business, right? The first thing that it says, set up a single purpose LLC. So you're setting up an entity. It's a renewable energy entity, and you're setting up a business. So the misconception in what I've seen out there is that people think of it, this is an investment. Well, it isn't, right? You're not an LP in a fund, right? This is not an SPV. You are setting up an entity between you and your spouse, and then you go and buy projects. You buy an asset, right? there are different structures that you can opt for. You can opt for a flip partnership, you can opt for a lease back, you can opt for an asset purchase, but eventually you're setting up an entity at your end, recommended between you and your spouse. And that entity goes either buys project or partners up with solar developers and solar company to take advantage of flip partnership and other structures. But this is, to say that again, this is not an investment. It's a renewable energy business, and you want to treat it as a business. Aris wants you to treat it as a business.
And Farhan, I think that's a really good, helpful clarification and does give a sense of what's involved here. We're going to get to, in a little bit, we're going to get to talking about the requirements that you'll face in qualifying for these benefits. One of the main ones, in addition to buying the asset, the solar panels, and making sure that they're completed and that they're running, is that you'll need to participate in this business, right? And that's one major way that this looks and feels a lot different from a traditional investment. In other contexts in what Valur does, you might be buying into a fund, as Farhan said, maybe you're buying into an oil and gas fund. With solar, you are buying an asset and putting it in a business, and then you're participating in running that business. Now, we'll talk about this. It's not the same thing as running your own business, kind of beginning to end, full stop. It's not that involved, but it is more involved than if you'd be just buying some stock or buying into a fund.
So the hours threshold are significantly lower than any other business like real estate. If you qualify, you can go for a minimum 100 hours material participation test. But the point is that you want to treat it as a business. Like, you don't want to treat it as an investment.
That's right.
And that's why material participation is important. And so, just covering this again. So you set up an entity. That entity goes and buys projects or partners up with the solar company, depending on the structure you opt for. And then you become active in that business, right? You do material participation, you satisfy the material participation test, and then you get credits and depreciation from those assets that you purchase. And you can take those credits and depreciation against your active income as long as you satisfy the active material participation requirement. So the requirement here is important because if most of our clients want to do this against their active income, they have to be active in solar, and that's what we convey. So tax credits and depreciation is one piece of the pie here. The other one is the income stream. And usually these length of these projects is 25, 30, 40 years that we have seen. That depends on the power purchase agreement, but there is a long income stream tied to these projects. I know where it's time sensitive, so I'll just move to the next slide, and we can.
Well, we can dig into that, and if you have questions, of course, we can answer them. But we'll show a lot of this in the case study that we're going to get to in a little bit. So 3 benefits: tax credit, depreciation, and income stream, and we're going to draw that out. So the first of those 3, the tax credit, the investment tax credit. Again, this might be a little bit remedial for some of you, but just to be very clear, make sure we're on the same page. What is a tax credit? A tax credit is a dollar for dollar reduction in the tax that you owe. You're all familiar with tax credits, even if you maybe aren't thinking about it that way. But when you buy an electric vehicle, you get maybe not anymore, and depending on which vehicle, but you would get a $7,500 tax credit for buying certain electric vehicles in the past. What that meant is if your income yielded a tax bill of $100,000, but you had bought an electric vehicle in that same year, your tax bill would be reduced from $100,000 to $92,500. That was a $7,500 credit, reducing your tax bill. And that's different from a deduction, which we'll talk about in a second. But so the investment tax credit is a credit. And what that means is that if you put $1 into a solar project, you're going to get a percentage of that back as a reduction in your tax bill credit. So how much is that credit? There's 2 important things to note here. First, I'm going to talk to you about what that percentage credit is. But then the second question is a percentage of what, right? So the percentage that you're going to get, you can see the math here. The baseline investment tax credit is 30%. Every project that qualifies under the law will get a 30% tax credit as a percentage of the total value of the project. And then in addition, the law allows for various kickers or adders that increase that credit percentage depending on the project qualifying. So you can see here, the project qualifies for an additional 10% credit if it uses between 40 and 55%, basically a majority US made materials. There's an additional 10 to 20% credit if the project is located in an area with a history of fossil fuel activities. So projects built in certain areas of West Virginia or the Deep South and other places like that, where there's been fossil fuel coal plants and mines and things like this, would get an additional credit. And then similarly, if the project is built in a historically disadvantaged community or on tribal land, there's an additional kicker. Most of our projects, Justin, I see your note there, maybe that we swapped those percentages. They're all in the range of 10% kickers. Most of the projects that you'll find today and the ones that we are offering today are going to be somewhere between 40 and 50% credit. Mostly because several of these adders just have not been implemented yet by the IRS in a way that allows projects to qualify. And so most projects that you find today are going to be between 30 and 50%. Ours are between 40 and 50. And so the question then is 40 to 50% of what? And I mentioned that it's a percentage of the project value. There's a really important thing here to talk about when it comes to the format of your project. As Farhan mentioned, there are different types of solar projects. There's flip partnerships, there's sale leasebacks, there are asset purchases. Most of what we do is a flip partnership, and so I'll just use that as the best example here. When you're buying into a flip partnership, let's say you put in $150,000. Most often, the developer or the sponsor of the project is going to match funds, and there's going to be about another $150,000 put into the project, and so the total appraised value of the project will be around $300,000. And this credit, let's say it's 50%, that would be 50% of $300,000, even though you only put in 150. And we'll talk about the flip partnership structure, but the shorthand, just to understand for now, is that you get to take the full credit, almost the full credit, on that whole project value. So if you put in 150 and the whole project is 300, you get to take a 50% credit, as just in this example, on 300. So if you put in 150, you'd be getting $150,000 credit reduction in your taxes, which means that you're reducing your taxes by the entire value of what you put in, even before we're talking about depreciation and cash flow. And that truly is a very, very large benefit. We often hear that it seems too large or too good to be true. It's very, very large. The way the math works here, your credit is usually going to be somewhere in the range of 80 to 100% of what you put in that first year. And importantly, this credit does reduce your taxes in the first tax year. Farhan, before I move on to depreciation, anything you want to add there?
Well, I think it's good. Justin mentioned about that correction. I think some of the projects, so energy community and low income, there's a possibility that the project falls in the same place, and then they qualify for both 20%. So that's 30% base, 10% for domestic content, and 20% for low income. So it can go to 60%. The rest of the 10% is for prevailing wage. But I get what he's saying.
It's a good point. And anyway, worth understanding that most of the projects these days are 40 and 50, and what we there's documentation to show qualification for these various credits. So that's the credit side. And like I said, you're typically recouping most of your purchase size just in that credit in the first year. And then in addition, you get depreciation. So what's depreciation? I'm sure most of you know this, but just to recap or to cover this, depreciation is the decrease in value of a physical asset over time. If you buy a house or you buy a car or you buy solar panels, the IRS assumes that they are losing value over time. There's wear and tear, there's usage, they break, they lose value over time. And you get to deduct from your income a portion of that lost value every year. And so importantly, whereas the investment tax credit is a credit, if you get a $10 credit, your tax bill goes down by $10. Depreciation is a deduction. Just like if you donate money to charity, it reduces your taxable income. Or just like if you, there are other deductions for various things. It reduces your mortgage. It reduces your taxable income, not your tax bill. And so if you get a $100 deduction, that reduces your income by $100. And so your actual tax savings are going to be $100 multiplied by whatever your marginal tax rate is. If I'm paying 40% tax and I get a $100 deduction, then I've saved $40 on my taxes via that deduction. So how do we calculate the depreciation deduction from solar? There's a bunch of math here. Basically, it's the project size. Again, if you put in 150, usually the project is around 300. Your depreciation deduction at the federal level is going to be basically, somewhere around 80% of that value. You can see the math here. It's 100% minus the investment tax credit, half of the investment tax credit percentage. That should be half of. And so if you put in 150, the total project is 300, and you get a 40% credit, you're going to get about a $240,000 depreciation deduction spread out over 5 years. How much of that do you get to take in the first year? And that 240,000 could save you as much as, $100-something thousand at the federal level, depending on your tax rate. How much of that do you get to take in the first year, which is a really important question and one that that a lot of people ask. That's a moving target, as you can see here. Bonus depreciation dictates the amount that you get to take in the first year. The 2017 tax bill implemented a bonus depreciation that started at 100% and has been being reduced every year since. And so this year, if nothing changes, the bonus depreciation rules dictate that you get to take 40% of your depreciation in the first year. Now that number might be changed, and we do think that there's a chance that it goes back up to 100% as a result of the negotiations happening in Congress right now. But you're going to get somewhere between 40 and 100% of your depreciation in the first year, which means on a $150,000 purchase, just as an example, happens to be our minimum. On a $150,000 purchase, we're talking about a depreciation deduction of somewhere in the range of $100,000 in the first year. And then another, 150 or so spread out over years 2 through 5, as well as some state depreciation that may apply depending on where you live. All in all, adding up that credit, which is 40% of the project size, and that depreciation, which is typically 80% of the project size, in general, we're talking about tax savings, tax benefits of somewhere in the range of 110 to 120% of your purchase size in the first year, as well as another probably between 30 and 60% over years 2 through 5. So if you put in $150,000, on average, we see people getting maybe $170,000, $180,000 in tax savings in the first year, which means, as you can tell, you're getting your principal back. You're getting back the amount you put in plus a nice return. And we'll show you all of this in a case study, but that's the idea. You're getting back more than what you put in when you file your taxes in April after year 1. And then we talked about there's also income stream, which we'll show you in the case study. Farhan, anything to add here?
No, I think that's great. For the, we covered about the federal tax credits and federal depreciation. There's also alongside that we have seen state level depreciation, which is an additional, cherry on top. Mm-hmm. And that numbers, differs depending on the state you live in, because there are different state tax rates, marginal tax rates. But if the value of the project, as per your example, where the client is putting 150K as a capital contribution and there's 150K worth of a debt, so it's 300K worth of project value. You're also getting state level depreciation on a 300K project value.
That's right. And in California and other high tax states, that can be significant.
That can be significant. Yeah.
Answering a couple of questions here. Ankit asked, what's the minimum investment needed? The minimum for 2025 is $150,000. The maximum is the sky's the limit. We have to put in 8 figures into solar projects if that's what you need to do. Great, we can make it happen. Manish asks, since this is considered a business, can someone, the stay-at-home spouse or whoever, claim business expense deductions alongside the benefits we've described? The answer is yes. This is a business that you're running, and if you have expenses, legitimate expenses as a result of running the business, absolutely you can deduct them. So home office, if it's dedicated to the solar business, yes. Most importantly, if you travel to the site to view it, which is a big part of the material participation that you'll do, that travel would be deductible. If you go to a conference, which can be part of your material participation, that would be deductible. So yes, the answer is yes, you can.
And I know this is not the part of the question, but one I think thing to call out here is that if you're married filing jointly, your spouse, even your spouse is not a part of your entity, they can still contribute hours towards material participation. As per our accounting partners, it's recommended to one spouse to go above 100 hours, but they can still contribute towards your material participation hours. So this is, an important thing that you can plan out. And, we'll talk about what are the benefits of doing this earlier in the year. And that, I think we'll cover this, what are the advantages in terms of material participation of doing this earlier in the year.
That's right. Jignesh asked, what's the requirement to be active? We'll get to that in a second, so don't worry. It's 100 hours, and we'll talk a lot about how people generally qualify when we get there. Risks and benefits. We've talked a lot about the tax saving side of things, so maybe we can just kind of put that here. But Farhan, do you want to talk about, about risks and benefits?
So, on the benefit side of things, like I said, on a higher level, there's tax incentives that's coming out of it, and there's an income stream. Now, the tax savings is, the number really differ depending on the structure you choose and everything, but it's a combination of credits and depreciation. Credits are federal tax credits offset against your tax bill directly. Depreciation is a deduction against your tax bill. You get state level depreciation, you get federal level depreciation. There's an advantage on both sides. On the income stream, usually these projects usually generate, 20 plus years of an income stream, right? There is an underlying agreement, energy agreement, which is called power purchase agreement. What that essentially means that there is an off-taker who is agreeing to buy the electricity produced by the system that you or the partnership owns. So there's an agreement. So off-taker doesn't have to put any money up front to buy the system. Whatever capital contribution you make goes towards building that system. Whatever electricity the system generates goes to the homeowner or to an off-taker, which can be a commercial, pays for the electricity. And that's how the income has been generated from these projects. Now, the income depends on the length of the PPA, power purchase agreement, and usually they can last for 40 years, they can last for 30 years. And the state where the project is, the cost of electricity defines the income stream of these things. But what we have seen, they can generate, on average 2.5% every year, depending on, or it can generate usually developers call out a 1% preferred return. The flip partnership in a lease back, the numbers differ. But the state where the project is located, the PPA rate, there are some variables here. We'll be happy to, get on a call with you, can walk you through the exact economics of this. But just to lay the land, even if it's 2% on average for 30 years, you're making 60% additional than what you have made from credits and depreciation. So credits and depreciation aside, that's what Jeff talked about. If you put $1 in higher level ranges, $1.60 to $1.80 over the course of 6 years, $1.20, $1.30 in year one, and then additional whatever you're going to make in the income stream side of things.
Farhan, let me just pause here. I don't know if people are monitoring the chat, but just in case they are, I want to address this to make sure that I or we didn't misspeak. Manish asked or mentioned depreciation isn't money coming back. It's a tool to reduce taxable income. I hope I was clear about this. If I misspoke, I'll just clarify here. That's absolutely correct. The math that we're doing here is correctly treating depreciation as a deduction. It's a reduction in your taxable income. So that's like when I was mentioning that, if you have a $100 deduction from depreciation, you then have to multiply that by your tax rate. And that's how much you're saving on your taxes. So here, if you put $150,000 in, and the project is therefore $300,000, the total depreciation deduction that you're going to get is going to be somewhere in the range of $240,000. You then have, that's not coming back to you. You have to then multiply that. That's a reduction in your taxable income. And as a result, you are multiplying that by your tax rate. And that's how much you're actually saving. So if you have a $200,000 deduction and your marginal rate at the federal level is, let's say, 30%, then you'd be saving $60,000 in taxes from a $200,000 deduction. And that's definitely the way that this is done. And that's, as you'll see in the case study, that is the math that we're doing. So I just wanted to make sure that everyone is aware that
Yeah.
yes, that's how it works, and that's how
And the reason we are saying that you're getting $20 and $30 is because it's a combination of credits plus that depreciation in that year. So you're taking, suppose, $80,000 worth of credits plus you are multiplying your marginal tax rate on that deduction amount, and that's how you're getting above the dollar in tax write-offs. So when we say those tax write-offs, that's we are applying those tax rates on that to
that's right.
get to the exact number. So that was the benefit side of things. On the participation, the rule of thumb here is that I want to talk about is active IRS classifies income into two buckets: active income and passive income. Right? Usually, your earned income, W-2 business which you are running, 1099 income is usually considered it's active income. And if you buy a rental property today and you're not active in real estate, that would be considered passive income. Or if you're an LP in a fund. So that's the major classification of income. And the reason it's important because active losses can be used against active income and passive losses can be used against passive income. So you cannot take passive losses and use them against active income. And I say this example again and again: if you buy a rented property today, that gives you some depreciation. You are not active in real estate. You cannot take that depreciation against active income, right? It doesn't work that way. You have to be either active in real estate via short-term rentals, or you have to be a real estate professional. Same in solar, the ARS requirement is just significantly lower. It's the same thing, but the hours requirement, there's a material participation test, which, minimum 100 hours. Obviously, we highly recommend going be above that, the more the merrier, but minimum 100 hours between you and your spouse doing business activities. And that way you can be an active participant in that entity and can use the credits and the depreciation that you get from your entity to your personal return and use them against active income. And that distinction here is very important. In terms of what activities particularly qualify, there isn't a very clear definition. Like there is no like a checklist that you can download from IRS website and can check boxes, right? Material participation, IRS, and that's the reason why I said it in the start that you don't want to consider it as an investment. This is a business. So all the business activities, it's a renewable energy business. You are not active in any particular project. You are active in the entity that you are setting up, the renewable business. So you learn about the industry, you go visit the projects that you have bought, you go on a site visit, you go on a conferences, you take enrollment in courses, learning about the industry, or decide you want to make additional purchases. And there are a couple of things, reviewing asset purchase, doing vendor selection on the project. There's a long list of things that you can do, but the material participation is an important piece here, and we'll tie it out to how, why you want to do this earlier in the year, because, there will be a lot of time for you to get to 100 hours, right? Minimum. But if you do it later in the year, there may not be enough activities. We'll come back to that later. I just want to make sure, we're not running out of clock. So fourth thing here on the risk side of things is the developer and counterparty project completion and durability. On the risk side of things, it's a combination of requirement plus so material participation requirement is from IRS in order to take the income against your, use the incentives against active income. The other requirement from IRS is that in order to take the incentives against active income, or any income, the project has to achieve mechanical completion. It has to be placed in service within that calendar year. So you cannot buy an existing project which has been already been developed and producing electricity. You have to buy a new project. And whatever project you buy within that calendar year, it has to be completed. It should be producing electricity within that calendar year, placed in service. And that is a very important piece. For any reason the project gets delayed, you won't be able to claim the credits and the depreciation for that calendar year. You have to carry them forward. And then the counterparty risk, who is the developer, and for how long they have been working, right? Whether there's insurance on the project, whether there is a manufacturer warranty on the equipment if something goes wrong, there is a recapture. Well, I can. I don't know, Jeff. I can speak 1 hour on this side of things. But this is kind of the higher level. The two major things is material participation and the mechanical completion, and there are some developer risk that you want to make sure you are mitigating. Um, we can schedule another webinar to talk about this particularly, but I just want to make sure we're on the
Yeah, for
clock.
sure. Alongside those risks, I guess, just to more kind of directly address kind of project risk, insurance, things like that.
Yeah, yeah, I'll cover this.
Yeah,
So in these projects, there is definitely an insurance, and that the developer carries the property insurance in case there's a natural disaster, there's a forest fire, there's a tornado, there's a hurricane. They carry an insurance, so the insurance pays for the equipment plus the labor to rebuild the whole thing, and plus IRS gives about 6 months to a year to rebuild the whole thing back. So there is definitely an insurance on these projects. There's also manufacturer warranty on the developers that we work with. So in case the project is not producing what it's supposed to because there's a specific degradation rate on these panels, they can just get it replaced. And all of these are there to make sure there is no recapture on these kind of things.
yep. All right. We just looked at the clock collectively and realized that we have 10 minutes. So let's
Yeah,
speed along here.
great.
I want to answer Casey's question very quickly. Amount of investment to be worth it. It's more about your income. The minimum investment is 100, or the minimum purchase size is $150,000. It's absolutely worth it to do that if your income is big enough to absorb the tax benefits, and that's typically if your income is in the range of probably what, $300,000 or $400,000, Farhan. Certainly, the more you make, the more you can use, but
Exactly.
it's not a very high bar.
Yeah.
Very quickly here, flip partnership structure. The idea, as we've already mentioned, is that you're going into a partnership with the developer. This is the most common approach. The idea is that you're buying a project and you're partnering with the developer. So you bring $150,000 and the developer does too, often by borrowing via debt. You buy the project together in the partnership, but it's arranged so that you, the tax equity investor, it's called, are able to claim the 99%, almost the whole tax benefit. And so it's really a way to multiply the tax savings. You buy the project with the developer, you put in half the money, but you get to claim tax benefits and multiply those credits and depreciation percentages by the full project size. I don't think we need to maybe belabor the structure point here. It's called a flip partnership. You can read about it, and then we can you can do the math, and Farhan will show you a case study. Requirements, we already talked about material participation. On-time mechanical completion is an important one, which goes to the next question, which is why do this now? It's January 22nd. A reasonable question might be, well, it's only January. Don't I have until the end of the calendar year to do this? If the project only has to be completed by December 31st, don't I have plenty of time? The answer is maybe, but probably not, for a few reasons. High level, importantly, the project has to be actually completed and plugged into the grid, mechanically completed by the end of the year. That means that it has to be started, that it has to be built. And so it takes a few months to do that. And when you build in the time that it takes to set this up, although Valur makes that part easy and quick, still, you need to get started, well before December. Exactly when we'll talk about. But in addition, you need to spend 100 hours, and doing that is much easier if you start earlier in the year. There are various conferences. The biggest one is in September, so probably easiest to do that if you go to that conference earlier in the year. Your cash flow starts soon after you buy in, and so the sooner you buy in, the sooner you start getting cash flow. And then depreciation is in many states quarterly. And so you get more depreciation deductions the earlier you do this. All of these are good points, and I'm kind of fighting the text here a little bit, because the basic point here is you need to get in line, you need to reserve a project, and it needs to get completed by the end of the year. And to guarantee that that's going to happen, you've certainly got to start before Q4. Really, you've got to start in the first half of the year, and even then, for all of these reasons, absolutely better to get the ball rolling. Even if you don't finalize your deal and wire money in January, absolutely better for all of these reasons to reserve your project and get the process rolling as early in the year as possible. The last point here is you can actually start claiming the tax benefits earlier in the year. If you buy in January, you and your accountant can look at the potential tax savings, the expected tax savings, and reduce your withholding on your W-2 income as a result. So if right now you're withholding as though your tax rate is going to be 32%, and you realize that you're going to save a bunch of money on your taxes, you might reduce your withholding by a few $1,000s potentially every pay period, and capture a lot of these benefits right away. Farhan, I want to answer Justin's question quickly, but about recapture. But do you have anything to add on the timing point? Bottom line, better to start earlier.
Yeah, I mean, on the timing side of things, I can't stress enough about this because I've seen a lot of people who wasn't able to get projects last year, and it was just about the timing piece of it. Even if the process of solar is slightly lengthy, it's a different thing. You need to set up an entity, you need to do diligence and everything. So it takes some time to get to the finish line of this. So the earlier you start, the more time you'll have on the material participation side of things, right? There's going to be plenty of activities for you to do in the year and easily achieve that, because that's an important thing that falls on you. And the mechanical completion, right? The project has to achieve mechanical completion. And the more time the developer will have to get the projects towards completion, you would be able to wipe off that risk off the table, right? It's very important. If you are doing everything and if the projects are not getting completed, you still cannot take the incentives. So what's the point of doing that? So, I mean, everything points to doing it earlier in the year. I can't think of any reason, but
Yep, absolutely. All right. Case study. We've got 4 minutes ish. Ankit asked, "Do projects get delayed?" This is an important question having to do with timing. Not usually, sometimes, and so starting in Q1 makes it much less likely that your project's going to be delayed to the point that it doesn't get completed this year. I think is that a fair kind of summary, Farhan?
Well, it depends what you're doing, but if you're doing it in the last quarter, then yeah, definitely higher percentage. But
but in general, very few of our projects get delayed, and
Yeah,
if you do it in June, you're going to have enough time to get the project done. So case study, Farhan, you want to take the reins here?
Yeah. Very quickly. So just this is a short case study to walk you through the exact benefits and walk you through the calculator. So for context, we have John. John is from California, merit filing jointly, have $1 million in earned income. And if John doesn't do anything, he owes about $391,000 in taxes to IRS. Right? He has an option to take that check and write it and never see it again, or the other option is he decides to put out of 391, put 250 in a flip partnership projects. So let me walk you through what happens. Jeff, do you want? Okay. So this is our calculator. We'll share the link so you can play around with the numbers and see the economics in here. So can you go to the earned income, Jeff, and click on next? We'll put in $1 million, same what John was making. California, merit filing jointly, go next. Yep, there you go. So same thing, expected tax bill without solar is right 391. But if we adjust the slider to 250, the benefits is a range. It's not a definitive, benefit, but if he's putting 250K in a flip partnership projects on the money that he owes to IRS, he is able to write off around $316,000 worth of taxes in year one. So John is $66,000 positive in year one with the tax write-offs. There's an additional benefit of $115,000 that comes, and it's mostly in a form of tax write-offs. And same, it's a write-off, not a deduction, because we're applying a 37% federal tax rate and then 13%, 12% for California, as you can see it in the calculator.
So just to double click on this, Farhan, you put in this guy, given his numbers, puts in 250, and he's paying 314 less in taxes this year. So instead of paying 391, he's paying $77,000. And so he put in 250, and then he gets back essentially 316 in benefits by April.
And I know we have this discussion sort of pending, but one thing I want to add here is this is the money that you owe to IRS, right? It is the 391, and people try to make circles around it. It's just that the simplest way to put this that I've realized is it's a money that you owe to IRS, right? It is just not yours in a way, right? You could put it in S&P for an year and see what you can make out of it, but you owe that at the end of the day to IRS, whether you do something about it or you write in a check, right? It's a whatever. If it's making 66 in year one, he's making that on a money that would have been lost in taxes anyways.
That's right, and that goes to what we're going to show here, which is, and we'll do this for a specific project. This is kind of the returns model, and we'll show this to you. If you click on explore available projects, you'll find that you can click through here and actually view a project. This is the one that we want to show you in the kind of little demo. It's a $250,000 project, which is what John was looking for, and you'll learn about that project here, where it is, description. The thing, and you can see the total tax savings here, as well as the revenue equaling a total return. The thing that Farhan's talking about and that I want to really highlight here, I know we're already a minute over, but I think this is really important. The return on investment here is not a traditional return on investment for a simple reason, which is, as Farhan said, that $250,000 that you put into solar was going to the IRS anyway. Instead, you put it into solar, but you get it back very quickly. You get that $250 back in this model, $250 back plus another 60-something thousand in the first year. And so in that first year, you're getting maybe something like a 25% return on that $250, but you're also getting your principal back, and it never went to the IRS. And what that means is that after the first year, this is no longer a traditional kind of investment return calculation, because you no longer have any money at risk. It's as if you bought $250,000 of Apple stock and you got a nice return. It grew to $315,000. And at the end of the first year, you got your original $250 back, but you got to still keep benefiting from the money that you gained. And so when people ask us, what's the annual return from solar? Well, we'll put the total return here. You put in 250, you get back 419. That's a 1.73 amount returned. But really, it's more than that. If I put in 250 and I get back my 250 plus 60 in the first year, and then I get another probably 60 or so, 70 or so over the next few years, in some senses, that's an infinite return. There's no denominator in the return calculation. You have no money at risk. And so we want to encourage everyone to think about this in whatever way makes sense for you. But it is absolutely, in my view, a more positive thing than traditional annual return thinking gets you to. I know that's a lot, and it's really kind of tough to get our heads around, and we've spent years now trying to find a good, pithy way to explain this. But bottom line, you can send the money to the IRS, or you could put it into this project, get it back, get the principal back after 1 year, and then keep making money off of it. And so the return is really, in principle, much higher than what the basic numbers show. In part because, as Farhan said, you could take that 250, and when you get it back after the first year, go put it in the stock market and grow it the same way you would have if you had never owed the tax at all. And that even further increases your returns. So.
Yeah.
We're getting to be well over, Farhan. Anything else you wanted to mention on the case study side of things?
No, I think that's helpful context. I think that's the major side of things. I mean, I know we have a lot of people who are waiting on the projects, and we want to announce that we'll be rolling out projects this week, probably late this week. So we're working on them. We have a long list of people who want to get started, and we're trying our best to make sure we have all our ducks in a row and the game plan and everything before we open the gates. So this week we'll have the projects ready for everyone, and we'll get started.
That's right. And if you haven't already, and if you want to make sure that you're on the list to receive notification when projects are live, you can let's see if this shows up. You can go to Tax Advantage Projects on the site and click Claim Your Project for 2025. You won't be committing to anything, but you'll put your name on the list, and you'll be getting all the communications that we send out about projects once they go live.
And we'll share this link in the follow-up email, so everyone has access to it and they can just.
That's right. And as always, you can check out Valur.com and our knowledge library at learn.valur.com. You can schedule a call with us at valur.com/schedule. and you'll get to talk to one of us directly, ask all the questions that I'm sure we didn't get to here today, given that we were rushing. I hope we did answer most of your questions. If you got anything more, email us, schedule a call, put your name on the reservation list, and we'll be in touch very shortly. Thanks, Farhan.
Thank you.